Warren Buffett doesn't panic. He survived the 1987 crash, the dot-com collapse, the 2008 financial crisis, the 2020 COVID crash. The man has seen everything. And right now, the single indicator he trusts more than any other is flashing at 233%. That's higher than it was before the dot-com crash in 2000. It's higher than it was before the 2008 housing collapse. By the end of this video, you'll understand exactly what this number means, why Wall Street is quietly terrified, and what you should be doing with your money right now, before the rest of the market figures it out. First, what is the Buffett Indicator, and why does it matter? It's a simple ratio, the total market capitalization of all U.S. stocks divided by the country's gross domestic product. Buffett himself called it probably the best single measure of where valuations stand at any given moment. A healthy reading sits around 100%, meaning the stock market roughly equals the size of the entire U.S. economy. Above 120% is considered overvalued. Above 150% is a warning signal. We are currently at 233%. Let that sink in. The stock market is valued at more than double the entire U.S. economy. The last time we came close to this level was March 2000, the peak of the dot-com bubble. After that peak, the Nasdaq fell 78% over the next 2 years. Retirement accounts were wiped out. Tech millionaires became broke overnight. An entire generation of investors swore they'd never touch stocks again. In 2008, the Buffett Indicator hit 105% right before Lehman Brothers collapsed. That triggered the worst financial crisis since the Great Depression. The S&P 500 dropped 57%. The average American lost 45% of their retirement savings. Today, we're sitting at 233%, and investors are still buying. Why? Because of artificial intelligence. The AI boom has driven valuations for companies like Nvidia, Microsoft, and Google to levels that would have been considered science fiction 5 years ago. The question everyone is asking, is this time different, or are we watching 2000 repeat itself? Here's what this means for your portfolio right now. If you have money in a standard index fund tracking the S&P 500, you are fully exposed to this valuation risk. Every dollar you have in the market assumes current prices are justified. At a 233% reading, historical data suggests the market is likely to produce significantly below average returns over the next 5 to 10 years, even if there's no crash. Let me put that in real numbers. If you have $100,000 invested today, and the market delivers its historical average of 10% annually, you'd have $259,000 in 10 years. But if we revert to the mean, which is what history says happens, your returns could be cut in half. That's a difference of over $100,000. And Berkshire Hathaway itself, Buffett's company, is sitting on a record cash pile of over $300 billion. When the world's greatest investor is holding more cash than at any point in his career, that is a signal worth paying attention to. Wall Street has taken notice. Goldman Sachs recently warned that the S&P 500 is likely to deliver average annual returns of just 3% over the next decade, compared to the historical 10%. JPMorgan put the probability of a market correction of 20% or more within the next 12 months at approximately 35%. And Moody's AI-driven recession model currently puts the chance of a U.S. recession at 49%. A coin flip on recession, a market at a record valuation, a new Fed chair signaling rate hikes. That combination has historically not ended well. Here's what to watch in the coming months. If the Fed raises rates in September, and all signals point that way, the cost of borrowing goes up. Companies that took on cheap debt to fund AI expansion will face pressure. Valuations will compress. If inflation cools and the Fed stays on hold, the market may hold its current levels. The soft landing scenario, not a crash, a slow grind down. But if inflation stays above 4%, which is what the latest data shows, the Fed has no choice. They hike. And over-leveraged, overvalued markets tend to correct fast. What smart money is doing right now? Increasing cash positions, shifting toward short-duration treasuries yielding 5%, reducing exposure to high-multiple tech stocks, buying defensive sectors, utilities, healthcare, consumer staples that hold value when growth slows. The investors who got out before the 2000 crash weren't geniuses. They just paid attention to the signals everyone else was ignoring. The Buffett Indicator is flashing red at 233%. Are you paying attention? Every day, we track the numbers Wall Street watches, so you know what's coming before your retirement account feels it. Subscribe, we post every single day. I'll see you in the next one.